Greetings, everybody. Welcome to the Liberty Call Weekly Economic Update for Monday, November 14th, 2022. Hope everybody's out there having a good day. Markets kind of took a turn for the worse this afternoon. They were in the green most of the day and unfortunately took a dive into the red. So I guess all that hope that inflation had mysteriously disappeared has gone away. So anyways, if it's your first time watching, please give me some thumbs up, like, shares, hit the subscribe button wherever it may be below wherever my finger is right here. So anyways, all right, well, let's go ahead and jump into the news. Let's see how the indexes did today. Dow Jones finished the day down 0.63 or 211 points at 33,536. S&P 500 was down 0.85, closed at 3958. NASDAQ was down 1.12%, closed at 11,196. Small caps are down just under 1.5%. The VIX was up today, 5.37%. It's currently at 2373. All right, see, Canada, they were down 0.94. Brazil was up 1.01. Mexico down 0.41. Moving over to Europe, Germany was up 0.62, UK up 0.92, France up 0.22, Euro Stoxx was up 0.49, Netherlands was up 0.53, Spain was up 0.84, and Italy up 0.58, Switzerland down 1.15, Portugal up 0.71. Moving further east, Russia, the MOEX was up 1.23, the RTSI was up 1.02. And the overnights in Asia, lots of red. Japan was down 1.06, Australia down 0.16, New Zealand down 1.03. In China, the Shanghai was down 0.13, the SCSE component down 0.24, China A50 up 0.25, DJ Shanghai basically flat at down 0.01, Hang Seng up 1.7, and the Taiwan weighted was up 1.19. So kind of a mixed day. Looks like Europe did pretty well, but things here domestically fell apart in the late afternoon, like I said earlier. All right. Well, let's dive into the weekly economic update for this week. The week on Wall Street, a cooling inflation number ignited a powerful rally on Thursday, sending stocks to strong gains for the week. The Dow Jones Industrial Average gained 4.15%. The S&P 500 added 5.9, NASDAQ rose 8.1, and internationals picked up 5.72%. Stocks surge. A lower than expected inflation report triggered the best one-day stock market gain in more than 2 years, as the news raised investors' hopes that the Fed might consider easing the pace of future rate hikes. Again, I wouldn't hold my breath. Inflation is still pretty high. I know everyone was jerking themselves off last week because it dropped to 7.7, but food and energy are still climbing. So again, don't get out over your skis up to this point. Let's see. The day's gains were pronounced in the hard-hit technology sector as the tech-heavy NASDAQ added 7.35%. Stocks initially rallied to start the week, but gave up some gains on Wednesday following a muddy and indecisive outcomes in the midterms. Friday saw stocks build on their gains to close out an exceptional week. Inflation moderates. Consumer prices rose slower in October, increasing 0.4% for the month and 7.7% for the 12 months from 12 months ago. Both numbers were below market expectations of 0.6 and 7.9. The core CPI, excluding energy and food, because no one uses that, rose a more modest 0.3% on a monthly basis and 6.3% from a year ago. The deceleration in prices was mainly attributable to price declines in used cars, apparel, medical services. Despite the progress, inflation remains well above the Fed's 2% target. A look behind the numbers shows that October 7.7 CPI was fueled by the largest monthly jump in shelter costs since 1990, a 0.8%. Shelter costs account for 1/3 of the CPI. Energy was up 1.8%, while food costs rose 0.6% for the month. Economic data coming out this week. Tuesday, we have the Producer Price Index. Wednesday, we have retail sales and industrial production. Thursday, housing starts, jobless claims. Friday, existing home sales and the index of leading economic indicators. Companies reporting earnings this week. Today on Monday, we have Tyson Foods. Tuesday, we have Walmart and Home Depot. Wednesday, NVIDIA. Cisco Systems, Target, Lowe's, and TJX. Thursday, we have Applied Materials, Palo Alto Networks, and Ross Stores. All right, so that's everything for this week's weekly update. Let's read through today's market recap. SP 500 struggles for direction as Fed officials signal higher for longer rates. The SP 500 swung between gains and losses Monday as investors digested remarks from Federal Reserve officials insisting further rate hikes were ahead, albeit at a slower pace despite recent data showing slowing inflation. Fed Chair Lael Brainard said Monday that it probably would be, quote, appropriate soon to move to a slower pace of increases, end quote, though added that there still was additional work to do on raising rates. The remarks arrived after Fed Governor Christopher Waller pushed back against investor bets on a pause on rate hikes, insisting that monetary policy tightening, quote, isn't ending in the next meeting or two, end quote. Defensive corners of the market, including healthcare, were up sharply, with Moderna and Biogen leading to the upside. Moderna jumped more than 5% after reporting that its COVID-19 boosters provided increased protection against Omicron subvariants than its original formula. Okay, sure. I'd like to see some data on that. Biogen advanced more than 4% on news that Roche's Alzheimer's drug candidate failed to show evidence of slowing dementia progression in 2 drug trials. Tech, meanwhile, was mostly lower, pressured by a more than 1% decline in Microsoft. Meta Platforms bucked the trend, however, rising more than 1%. More than 2%, a more than 2% rally in advanced micro devices boosted chip stocks after receiving an upgrade from Baird and UBS. UBS upgraded AMD to outperform from neutral and lifted its price target on the stock to $95 from $75 on expectations that demand for chips is set to resume as the glut in chip inventories is nearing a peak. Amazon.com slipped more than 1% as the e-commerce giant reportedly plans to lay off about 10,000 employees as soon as this week. Energy stocks shrugged off the slump in oil prices after OPEC cut its estimate on global oil demand amid a weaker global economic backdrop. Valero Energy, Pioneer Natural Resources, and Chevron led the gains in the sector. On the earnings front, oat-based drinks maker Oatly reported a larger than expected quarterly loss as revenue fell short of Wall Street estimates, sending its shares more than 11% lower. In cryptocurrency news, Binance, the world's largest exchange by trading volume, says it would launch a recovery fund to cash-strapped cryptocurrencies starved of liquidity in the wake of the collapse of FTX. Yeah, and if you haven't been paying attention to the FTX thing, that is a mess. Looks like they were juggling money all over the place and defrauding their customer base, which is not a good thing. So if anyone wants to talk about that directly, feel free to give me a call. I'd be happy to go through the details on that. All right. Next article has to do with the Fed. Fed may slow pace of rate hike soon. Brainard. I mean, look at this woman. She looks like an evil witch from somewhere. I mean, God, she does not look healthy. The Federal Reserve will likely soon slow its intra-trade hikes. Fed Vice Chair Lael Brainard signaled on Monday as the U.S. Central Bank tries to figure out how high borrowing costs need to go and how long they should stay there to bring down inflation. Quote, I think it will probably be appropriate soon to move to a slower pace of increases, but I think what's really important to emphasize is we have additional work to do, end quote, Brainard said in an interview with Bloomberg in Washington. Quote, it's really going to be an exercise on watching the data carefully and trying to assess how much restraint there is and how much additional restraint is going to be necessary and sustained for how long. And those are the kinds of judgments that lie ahead for us, end quote, she said. Brainard is the second-ranking Fed official in as many days, along with Governor Christopher Waller on Sunday, to indicate the Fed is ready to begin moving in smaller rate hike increments as soon as its December meeting, while still emphasizing what Brainard called the central bank's resolve to keep pushing rates higher as needed to battle a surge in inflation. Fed Chair Jerome Powell has signaled that the central bank's next move may be smaller to give the Fed more scope to judge how the rapid rate hikes it has approved so far this year are affecting the economy, an impact that may only be apparent over many months. But he also signaled the policy rate may next year peak at a rate higher than the 4.6% level that most policymakers had expected in September. Brainard's remarks underscored that view. Quote, It makes sense to move to a more deliberate and more data-dependent pace as we continue to make sure there's restraint that will bring down inflation over time, end quote, she said. Data released last week showing a slowdown in overall inflation, and particularly in goods, was reassuring, Brainard said. And so far, many economic indicators have showed continued strength despite the Fed's aggressive rate increases, with hiring in particular still strong. But Brainard, Waller, and other officials agreed they will need to see the pace of price changes continue to slow to become comfortable. The Fed is getting control of the situation, noting that some key parts of the price index, such as rents, may not peak until well into next year. As the Fed policy rate gets more restrictive, Brainard said the balance of risks will become more, quote, two-sided, meaning that higher interest rates could start slowing the labor market enough to begin to endanger the Fed's second mandate of maximum employment. Currently, the U.S. unemployment rate is 3.7%, below the 4% level most policymakers believe reflects a long-run sustainable rate. Recent labor market data suggests cooling, Brainard said, and lessening wage pressures. Quote, as we go forward, risks are going to be two-sided if we get to be more restrictive or further into restrictive territory, she said. So we'll be balancing those considerations, end quote. Yeah, they really want to lower interest rates really, really bad because I guess their friends in tech are just getting clobbered. So, that might be the reason. All righty. Next up, one last article here. I actually shared this last week on the social media pages, but I wanted to go ahead and read through this with y'all. It's titled, comes from the Mises Institute. It's titled The End of World Dollar Hegemony, Turning the USA into Weimar Germany. Something I've been saying for a while. You keep printing money, we're going to wind up in big problems. In a recent essay, actually this is written by Patrick Barron, and let's go ahead and dive in. In a recent essay, I explained how over time the U.S. abused its responsibility to control the supply of dollars, the world's premier reserve currency, for settling international trade accounts among nations. This abrogation of its duties is leading to the likely adoption of a new reserve currency, commodity-based and controlled not by one nation but by many members. But by members, all watchful that the currency is not inflated. Let us continue the analogy of an individual receiving a, quote, magic checkbook, which allows him to write as many checks for as much money as he desires. Receivers of those checks could only pass them along to others through the normal course of trade. Over time, the owner of the magic checkbook becomes increasingly irresponsible. He funds all kinds of welfare and warfare initiatives. Naturally, dollar reserves build to levels completely unnecessary for peaceful exchange. Prices start to rise faster and at a faster and faster rate. Then a reform consortium assembles a team to offer an alternative currency. Why, one may ask, is that such a problem for the dollar and dollar users? A successful alternative reserve currency would dilute demand to hold dollars. When demand for dollar drops, its price must drop until its supply drops. A drop in the dollar's price is just another way of stating that its purchasing power falls, i.e., more dollars are required to buy the same goods and services. Through irresponsible use of the magic checkbook, you have obligated yourself to funding a free-for-all of entitlements such as Social Security, Medicare, and the military-industrial complex, being the largest by far. Politically, it may be almost impossible to cut any of these three categories of spending to the extent necessary to arrest the dollar's drop in purchasing power. The world has seen this before, and not just in less developed nations like Zimbabwe. The U.S. will find itself in the same trap as experienced by Germany's Weimar Republic following World War I. The Reichsbank, Germany's central bank, printed paper marks to placate powerful constituencies within Germany. As the Reichsbank printed more money, the purchasing power of the paper marks dropped, and herein lay the trap. Rising prices led powerful constituencies to demand increases in pay and benefits. In industrial labor unions, government civil servants, welfare recipients, old age pensioners whose life savings were being decimated, all demanded more money. Strikes and violence became endemic, so the Reichsbank printed more money, which of course simply led to higher prices and another round of payment increases, which led to even higher prices until the paper mark became worth more than wallpaper became worth more as wallpaper than money. Why did the Weimar Republic government continue to increase payments, and why did the Reichsbank continue to print papier marks? Many sophisticated answers have been advanced, such as the government and the Reichsbank deliberately destroyed the papier mark in a roundabout plot to thwart the financial terms of the Versailles Treaty, in which a defeated Germany was ordered to pay reparations to the Allied powers. But the simplest answer is that both believed that there were no choice than to increase payments and print money in a crisis. It was felt that powerful constituencies must be placated in the short run, but short-run tactics just made things worse. There was neither the political will nor the economic understanding of the need to end excessive spending and currency debasement and endure the pain thereby induced. I feel the same way. The same is true today. In fact, the seeming lack of adverse consequences, all in the long term, and advantages of printing money in the short term have led to knee-jerk response by the Treasury and the Federal Reserve Bank to increase the money supply and lower interest rates in the face of any economic problem, even higher prices themselves. For example, just look at Britain. Its energy shortage have caused prices to rise. The government's response has been to pledge payouts to households. That's right, no pledge to dismantle barriers to increase energy production, just a pledge to increase the government's deficit, which requires more money printing. And as the saying goes, you can't make this stuff up. One thing is certain, however, what Britain can do, the U.S. can and will do in spades. Hyperinflation is a real possibility. Remember, the Reichsbank in Weimar Republic Germany actually had to print physical money. The U.S. Federal Reserve need only click a few buttons on a computer. As prices rise, powerful groups demand more money. Police, firemen, road workers, etc. demand that will not suffer a lowering of their lifestyle. Since the government is spending someone else's money, it accedes to these demands. Back to our British example, the exchange value of the pound has been plummeting in currency markets, leading to serious consequences. The Bank of England was forced to raise interest rates, and now government debt has become unaffordable. So the bank, as handmaiden to the government, has applied the only political permissible remedy that it knows. Its computer's money printer is forced into overdrive just to keep up. Where does the government get money? Get its money. State and local governments get money from state and local taxes. So captive property owners get increased tax bills to pay for maintaining public school teachers, police, etc. Social Security recipients must be compensated, of course, so payroll taxes are increased, which depresses business. American products become less competitive on the national and world market. The price spiral continues to destroy all in their path until the dollar loses all purchasing power and society descends into chaos. And not one politician in 1,000 understands what happened, or if he does understand, does not have the political will to do anything about it, i.e. reduce public spending, liquidate the Fed, and tie the dollar to our still significant gold reserves. It can be done. So, my guess is that the people in government and at the Fed will do nothing until everything collapses, and then we have, civil war, and it's going to be a big mess. But that's my long-term prediction. I mean, I think things afterwards will be fine once we get rid of all these government parasites who leech off of those of us who actually work in productive society. But until that day comes, it's just going to be real rough. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And hope to see you guys tomorrow. Bye-bye.